Current market price update. Procter Gamble NYSE PG is currently sitting at $145.13 as of the last closing bell, with active pre-market negotiations pushing the price slightly higher, hovering near the $145.20 mark as traders position themselves for the opening bell. The stock registered a significant intraday move of plus 1.60% in the prior session, a robust green candle that stands out starkly against a backdrop of broader market uncertainty. Most investors look at a ticker like PG and see a digital fortress. The expectation is simple, almost primal. You park your capital here when the world feels shaky. You expect a bond proxy, a steady grinder that ignores the volatility of the tech sector, a safe harbor where your money sleeps soundly while you collect a dividend. That is the expectation, that Procter & Gamble is the financial equivalent of a warm blanket. But the reality, the jagged truth that the charts are screaming right now, is that this stock has been quietly bleeding out while the rest of the market partied. The reality is that PG isn't acting like a safety trade. For the last 6 months, it has acted like a distress signal. We are looking at a stock that is down roughly 13% year-to-date in a year where the S&P 500 has been relentlessly hunting all-time highs. The tension here isn't about safety, it's about a massive disconnect between price and value, and the last 5 days suggest a violent rotation might finally be underway. When you pull up your Fidelity mobile app or glance at the dashboard on your interactive broker's trading screen, the first thing that should jump out at you isn't the price, it's the volume. In the last session alone, over 12.9 million shares changed hands. That is not normal retail chatter, that is institutional heavy lifting. To put that in perspective, the average volume is closer to 9 million. When volume spikes 40 to 50% above the average on a green day, especially after a brutal months-long downtrend, it signals that the smart money is stepping in to defend a level. They are drawing a line in the sand. You might see Tesla stock or Nvidia stock trading hundreds of millions of shares on pure speculation, but when a boring mega-cap staple like PG sees this kind of volume swell, it indicates a structural shift in portfolio allocations. Fund managers are likely rebalancing, moving profits from overextended tech plays into the beaten-down value sector, and PG is the primary beneficiary of that rotation. Let's break down the mechanics of this move because it affects everyone, whether you are doing self-investing through Robinhood stock trading or relying on Schwab Intelligent Portfolios to manage your retirement. The stock has posted 5 consecutive days of gains. In the technical world, this is often called a thrust. After bottoming out near $138, a level that terrified many long-term holders, buyers have aggressively stepped in. However, we need to be incredibly careful about calling a bottom. The stock is still trading well below its 200-day moving average, which currently sits up around the $157 level. For the uninitiated, the 200-day moving average is the trend line that separates the bulls from the bears. As long as PG is below that line, this is technically a downtrend, no matter how good the last week has felt. The reality is that we are in a tactical bounce within a structural correction, and the next few weeks will determine if this is a true reversal or just a dead cat bounce before lower lows. Why has this titan of industry been selling off? The narrative expectation is that inflation helps companies like P&G because they have pricing power. We've been told for years that if the cost of raw materials goes up, P&G just raises the price of Tide or Pampers and we pay it because we have to. But the reality of 2025 has shattered that assumption. We've hit a ceiling. The consumer has finally pushed back. Volumes, the actual number of units sold, have been under pressure. You can only raise prices so many times before a shopper in a grocery store looks at that orange bottle of Tide, then looks at the generic store brand next to it, which costs 30% less, and makes a switch. That behavior change is the invisible killer of pricing power. It's the reason why, despite decent earnings beats, the stock has drifted lower. The market is forward-looking. It doesn't care what you earned last quarter. It cares that your ability to hike prices is vanishing. If you are using SoFi Invest or browsing investing sites looking for investment help, you might have noticed a lot of mixed ratings on the stock recently. This confusion is warranted. On one hand, you have the dividend king status, 68 years of consecutive dividend increases. That is royalty. It's the reason Fidelity Wealth Management accounts are loaded with this stock. It yields nearly 3%, which is attractive. But on the other hand, you have the growth problem. If pricing power is gone, growth must come from selling more stuff. And in a world with a slowing population and intense competition, selling more soap is incredibly difficult. This is why the volume spike we saw yesterday is so critical. It suggests that at $138 to $140, the valuation finally became too cheap for the big banks to ignore. They are betting that the worst of the volume decline is priced in. There is also a significant piece of corporate news adding a layer of complexity to this trade. It was just disclosed that Jennifer Davis, the CEO of the healthcare division, a massive chunk of the P&G empire, is set to retire in 2026. Executive departures at this level always introduce a variable of uncertainty. Markets hate uncertainty. While a planned retirement is better than an abrupt firing, it signals a changing of the guard during a turbulent time. The healthcare segment, which houses powerhouse brands like Oral-B and Vicks, has been a steady performer, and investors will be watching closely to see if this leadership transition disrupts the strategy. It's a reminder that even these monolithic companies are run by people, and people leave. Comparing this to the broader market provides another layer of insight. If you look at Apple stock, it moves based on iPhone cycles and AI integration news. Tesla stock moves on Elon Musk's tweets and robo-taxi promises. PG moves on macroeconomic shifts. It is a barometer for the health of the American consumer. When Robinhood fractional shares traders are buying tech, they are betting on the future. When they buy PG, they are betting on survival. The current rotation into PG suggests that the market is becoming defensive. It suggests that despite the soft landing narrative, big money is quietly parking cash in assets that can survive a recession. They are buying toothpaste and diapers because regardless of what the Federal Reserve does with interest rates next month, people will still brush their teeth and change their babies. This brings us to the Interactive Brokers platform data regarding options flow. We are seeing an uptick in call buying for the January and February expirations. This is bullish. It means traders are paying a premium today for the right to buy the stock at a higher price next month. They are betting on a continuation of this 5-day rally. However, there is a wall of resistance waiting at $148 and again at $152. These are the levels where the bag holders, the people who bought at the highs and are trapped in the red, will look to sell and get their money back. As the price approaches $148, expect turbulence. It will not cut through that level like butter. It will be a grind. For those of you who utilize SoFi Active Investing or Fidelity ETFs, you understand that P&G is often the top holding in consumer staples ETFs. This creates a passive inflow effect. As investors get nervous about the high valuations in the tech sector, they pour money into defensive ETFs. These ETFs are then mathematically forced to buy PG shares regardless of the price. This mindless buying provides a floor for the stock. It is the hidden engine of modern market structure. Passive flows can arrest a decline even when the fundamentals look shaky. It is a dynamic that didn't exist 20 years ago, but now is the dominant force in price discovery. Let's pause for a moment and look at the psychological battle you face as an investor here. The temptation is to chase the momentum. You see 5 green days, you see the price moving up from $138 to $145, and you want to jump in. This is FOMO, fear of missing out. But professional trading, the kind practiced by institutional desks and successful individual brokerage accounts, is about risk management, not chasing. The risk-to-reward ratio here is neutral. We are right in the middle of the trading range. Buying at 138 was the masterstroke. Buying at 145 is chasing the middle. If you are looking to enter, you want to see a pullback, a retest of the $142 level to confirm that the buyers are actually serious. Speaking of consumer behavior and the real economy, I want to hear from you. The shift to private label brands is the biggest threat to P&G's dominance right now. Comment below, have you switched to generic or store brand versions of household items like laundry detergent or toothpaste in the last year? I want to know if the trade down effect is real in your household, because that is the single most important data point for this stock's future. Now, let's look forward. What is the end game for Procter & Gamble in 2026? The company is pivoting towards efficiency. They're cutting costs, streamlining supply chains, and focusing on superiority, their internal metric for ensuring their product is noticeably better than the generic version. If they can prove that Tide cleans better than the Kirkland brand, they win. If the consumer can't tell the difference, they lose. It is that binary. The future scenario here involves P&G becoming a leaner, slower growth cash machine that aggressively buys back its own stock. Share buybacks are the secret weapon.